Hello, everyone. Today on the Final Bar, we'll do our normal Monday routine. We hit the market from three directions: top-down macro, bottom-up stock picking, sector rotation. Purpose of this show on Monday is to break down the key charts in each of those areas, focus on the big picture, how it's evolving. Today, a bit of a mean reversion day, a bit of a recovery day after a lot of weakness going into the weekend last week. Nice bounce higher, but consumer staples, the number one sector, not exactly offense. Ladies and gentlemen, this is the Final Bar. Hello, everyone. Welcome to the Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a rainy Redmond, Washington. Thanks for joining us every weekday after the close as we focus on the market environment using the power of StockCharts, using technical analysis tools and the technical toolkit to better understand fear and greed, those emotional states of investors that drive asset prices higher and or lower. We're going to talk about the overall market environment. Monday's a fun show because we get touch on the key themes following, sort of mirroring my own process of understanding the market, starting macro and going to micro. I'll look at big picture and talk about the overall movements. The S&P 500 bouncing just fine today, up 1.2%. But the leadership today was sort of an interesting one. Earlier in the day, I saw utilities and real estate as the top two sectors. So the market's bouncing higher, driven by Utes and REITs, which is not offense, right? Those are not offensive sectors. At the end of the day, consumer staples finishing on the top, but overall a bit of a move back away from the growth trade back into the value trade, and that was a big theme I think today looking at the markets. We have great guests on the show. I had a lot of fun last week with guys like Tony Dwyer, Mark Chaikin. We're so fortunate with the quality of guests we're able to bring through. More of the same this week. Tomorrow on the 7th, we have Mark Newton from Fundstrat Global Advisors in New York. On Wednesday, Gary Dean from sentimenttiming.com. On Thursday the 9th, Samantha Leduc from Leduc Trading. And then the week after, on Tuesday the 14th, we have Jonathan Krinsky joining us once again from the New York area. Also, as a reminder, we have our holiday special going all during the month of December. If you've ever thought about joining StockCharts as a premium member, now's a really good time to do it because we have a good deal set up for you going forward. You get a couple free months for registering as a premium member. It gives you a lot of great capabilities, a lot of the really cool charts we show on this program, and things like the scanning engine and the chart list. Being a member allows you to use that to its full extent. So go to stockcharts.com/special for more info on that holiday special. Runs through the holiday season this year. Let's continue on today's show with our market recap. As I mentioned, an update for the markets for sure. The question in this sort of move higher after the drop that we've had in recent weeks is the dreaded dead cat bounce, and it's sort of a horrible visual to describe the market. And what do you mean by that is when a market moves down fairly suddenly, you have a little bounce higher, and a dead cat bounce, sort of like the overall conditions are still not good, but it's natural to have a quick counter trend move higher, especially after a sell-off. So now as we're sort of testing moving averages, now as the S&P is testing that 45.50 level, you see it's able to find a bid and pop back higher. So the S&P getting back above 45.50 right after the open, closing around 45.90, which was 1.2% higher than yesterday. Mid caps and small caps both up a little more, with the small cap 600 index up 2.4%. And again, when value-y stuff is up, when the cyclical sectors like industrials and materials are higher, usually small caps are going to do better because they're a little more weighted in those sectors, a little underweight relative to the S&P 500 in terms of like technology and consumer names. So the movements today in the sectors make sense as to why you're seeing the cap themes that you're seeing. The VIX plunging to 2750, and I say that with a great deal of sarcasm. The VIX above 30, which is significant. It's one of the highest readings we've had in 2021. Still very, very elevated relative to where we've been. So be assured we are not yet in a low volatility environment. Far from it. Yields, interest rates popping back higher, and interest rates came down pretty significantly on Friday, with the 10-year yield ending the day around 135, which is pretty low relative to where we've been. Bounced back up to around 143. We talked for a while earlier in the year about 150 to 175 was sort of that range. We broke below there just in the last couple of weeks. I think we may be seeing just lower rates for a bit, but you're getting a nice bounce higher today, which is interesting. 150 would be a key level to watch there. Bond prices obviously coming down as interest rates going higher. Gold, silver, both down today, but not by much. The GLD was down 0.25%. The energy side of the commodity complex, if you're looking at the USO, looking at oil prices up, just find all the natural gas prices are coming down pretty significantly today. The USO up about 5%. The energy sector about mid-range for the S&P, up about 1.5%. Cryptocurrencies have been fascinating. And over the weekend, you saw a plunge there. This was in the last 48 hours, getting below 50,000. We're going to go after we talk about the chart of the S&P. I'll try to remember to go to Bitcoin and some of these other asset classes next. We're going to come back a little later. We'll touch on sectors. We'll touch on individual stocks, and we'll complete our Monday routine. So let's look at a chart of the S&P 500. And this is really the last week has been sort of a choppy sideways feel. And so, if you get away from just the daily ups and downs, the last 4 days have been big up days and or big down days. We haven't had sort of a sideways day in quite a while. And that's really for the last couple of weeks. That's sort of the environment that we've been since we came off of that most recent all-time high at 47.50. From there, you have this 1 week decline and then we've had a 1 week of just choppy, volatile nowhere. So volatility has increased, and you can see just the range on the bars. I think about the average true range, which is literally the daily high to low, adjusted to yesterday's close in the case of a gap. But overall, you can see that these are much wider ranges than we saw here in mid-October to mid-November, right? It was sort of slow and steady gain sort of market. This is more of a choppy period, more of a volatile period. Feels a lot like the month of September. To be honest with you, we had some wider ranges to the days. You had a lot of movements, both up and down, even though the trend has been more negative. If you look, the last week looks a lot like the bottom that we had in end of September, early October. We had big wide ranges. We were closing near the highs or the lows every day. It was sort of a which side is taking control. And then eventually you can see the bulls took control as we broke out of that range and moved to the upside. Can't really declare that yet. And that's why you can still think of this as a potential dead cat bounce, right? This is one of two things. Either it's a sudden pullback, we reset the table at the 50-day moving average, as we have many times in 2021, and reset for the next move higher into year end. Option B, this is what's called a dead cat bounce, sort of that initial bounce higher before you have the next move lower, and this corrective period continues. And again, it's hard to tell which one of those that is at this moment because they both look kind of the same. The question is how we depart this range we've been in for the last week. Do we sort of continue to push higher, or do we break below there? So if we break above like 46.50, do we break below 4,500? That will tell you which of those answers is correct. Overall, I would say the overlying themes to pay attention to. This, bearish momentum divergence certainly was a great indication of excessive upside and the potential for moving downside. That really doesn't provide a downside target in terms of where we would go to, except we've bounced off the 50-day and have bounced off of the RSI 40 level, which is both more characteristic of a bull market phase. That's sort of what a pullback within a bull market would sort of look like. The next leg lower is where these indications would deteriorate. It would look no longer like a short viable bounce, but more about a breakdown. So, again, looking at a chart of the S&P, I think 4,500 here, last week's low, is a really good place to keep an eye on to see if that's able to hold. I mentioned some of these other asset classes. Let's go here quickly. So Bitcoin had quite a bit of movement. So over the Friday, Saturday into Sunday, you had a huge acceleration to the downside where you saw this big rotation down, and Bitcoin went from the upper 50s down to the low 40s, mid to low 40s in about 48 hours, which is quite a sudden move. Now, this is not unusual. And if you look back at the chart of Bitcoin just for the last 12 months, you've seen plenty of times where you have these significant moves. And I even highlighted some of the drawdowns here. In the last year, you've had drawdowns of 54%, 25%, and the current drawdown of around 37%. Bitcoin has often had 50+% pullbacks, even during this long-term secular bull move from single digits all the way up to where we're at. And so this is just, I think, the nature of a highly speculative market with a lot of uncertainty and a lot of volatility. So do I see signs that this is bottoming out? No, I don't really. And I don't really see it stabilizing just yet. Wait, remains to be seen. I think 50,000 is a key level. That's a level we paid attention to in August and September. We're now below that. Regaining that, I think, would be important. Establishing some sort of higher low would be helpful too. And we've certainly not been able to do that just yet. Have to see how this chart evolves during the course of the week. Let's continue on with our next segment, sector setups. Let's talk about we talked about the big picture, the S&P pulling back, but now sort of in wait and see mode as we wish to see which side gains control. Do we see this rally into the end of the year? Do we see continued deterioration maybe before that? And I didn't mention what I think is most likely. Yeah, I could see a little further downside and then further upside going into the end of the year. Those last 2 weeks of the year, it would be incredibly unusual to not see strength going into the end of the calendar year. That's the Santa Claus rally. There's a reason why it has a name, and people often refer to it. It's really common to have strength going into the end of the year. It is not unheard of to have weakness in the first week or two of December, and I think that's what we're seeing here now. So I wouldn't be surprised if we have a little more backing and filling, setting the stage for a nice run into year. And that would be my general base case, but let's see how the charts actually evolve. Now, on a day like today, and during this period, I was asked on the mailbag on Friday about a rotational environment. And I think that's what this year has been a lot of times. It's looking at sector leadership just on the sector summary page on an average day. It's seeing what's working. Is it growth over value? Is it value over growth? And today's certainly more of a value over growth day, with sectors like staples and industrials and utilities up in the top half, outperforming the S&P today. The growthy sectors, things like technology, things like consumer discretionary, not doing so well. With healthcare, by the way, as the worst performer. Now, you have some real crazy movements in healthcare. Things like Pfizer and Moderna both down pretty significantly today. If you look at the biggest, the stocks the most down today, you're seeing a lot of those names there in the top 5. We're going to get to some of these other travel-oriented names when we get to our next segment, by the way. But let's look at the RRGs, the relative rotation graph. Julius de Kempener created this visualization many, many years ago, and I've enjoyed following Julius and his work and enjoy working with him here at StockCharts now. But he designed this as a way to visually indicate or represent the 11 S&P sectors, how they rotate around the S&P there at the crosshairs in the middle. Up and to the right is strong with improving momentum. Down and to the left is weak with declining momentum, if that makes sense. So you can see the bookends. You can see the relationship between what's working, things like consumer discretionary, technology in the leading quadrant and heading northeast, or easterly, I guess, versus something like communication services in the lagging quadrant and heading southwest. If I'm looking at the 11 S&P sectors and you ask me to pick out the worst overall sector from a technical perspective, I don't know if I could come up with a reason to not say communication services. That would have to be it. And again, there are pockets of interesting charts within communication services, but as a sector, as a whole, just incredibly weak. And you've seen the deterioration on some of those charts for weeks, if not months. And I'm thinking of things like Discovery and Viacom, so those entertainment names, Disney even, with just an inability to hold support and just breaking down and showing distribution. Compare that with things like consumer discretionary, where there are a lot of names that are working just fine. Technology, where it's not hard to find stocks making new highs, and the new highs and new lows list tends to be pretty even for technology. There are a lot of names in there, but overall showing some real signs of strength. Energy is interesting. If you look, it is the strongest by the fact that it's furthest to the right, but you can see it's heading the wrong direction. It's heading due south, if not just a little bit left of center. So overall, that's not encouraging, right? The strongest indication on this would be in the leading quadrant heading northeast. That's the strongest. In the lagging quadrant heading southwest is the weakest. Everything else is sort of in the middle and showing different opportunities. In terms of most improved, where there are opportunities besides technology that I think is probably in the best position, it's materials, industrials. This is consumer staples here, and utilities that are just rotating both really, really close. It looks like staples just barely in the improving quadrant, utilities not too far behind. But overall, these are some of the cyclical sectors, some of the defensive sectors actually, including staples and utilities, are actually rotating a little more strongly. Let's look at the 11 S&P sectors next using the candle glance function. So as I've mentioned on the show before, one of the things we would do in my Fidelity days was print out way too many charts. We printed out a lot, but it was the way we were trained to do it was looking at charts and making a lot of notes on paper. That's what our predecessors had done years ago at Fidelity. And it was really helpful to take a pile of charts and sort them into different piles and just keep filtering into the best and the okay and the worst, and then filtering underneath each of those groups and differentiating them a little more. And the candle glance function basically allows you to do that. If you have the candle glance tool and a piece of paper, you can quickly identify what's working and what isn't, because you can look at all of these on a similar time frame, same time frame, and looking them on apples to apples basis. So what jumps out at me today is this pop in consumer staples, and I mentioned that staples is improving. You can see the relative strength is just starting to tick higher, but the problem for staples is that the trend overall has been very, very negative. I haven't seen enough yet to think, wow, this is a really good time to allocate into consumer staples, because overall the long-term trend has been incredibly weak on a relative basis. There are pockets of opportunity. We'll look at some of the names that are jumping today in our next segment. But worth noting, of course, a sector making new all-time highs when others are not would be worth looking at. So staples getting very close to their highs from earlier in November. You can see utilities jumping as well today, popping up. And and again, if I'm thinking of the overall market environment, not just looking at a chart of the S&P, but looking at that next level down to identify key themes, the fact that staples and utilities are the two sector charts that pop out at me is not super encouraging to me, right? You want the market rallying with offense leading the way if you want to feel optimistic about further upside. This is investors getting defensive if you're owning staples and utilities. You own that because you're worried about what might come next, not because you're excited about the market ripping from this moment, is the way I would generally thinking of it. So utilities on a relative basis actually starting to improve over the last couple of weeks. That is very much a sector I'll be paying attention to. And it's worth noting, right? Sectors like utilities don't just lead during bear markets, right? They're not just defensive sectors. They actually at times have led during bull market phases. It's worth noting the sectors that work regardless of the market environment. Now, when you think about today, of course, I would look at communication services. So everything is bouncing today. You have a nice recovery day. So, communication services jumping just fine, up 1.6% on the XLC. That's not bad. However, the problem is it's coming out of extremely weak levels, right? This is the relative strength over the last 3 months, and we're just popping a little bit from there. We need to take a quick commercial break. We'll be back with my next segment, Shifting Stocks. We'll see you in a minute. Hello, everyone. Welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. So good to have you join us every weekday after the close as we focus on the message that the markets provide back to us. What can we understand about price, trend, and momentum? A couple of quick announcements before we get to our next segment. Number one, we love to hear your questions. Anything you're running into as you're trying to analyze your own charts, let us help you, aim your ship in the right direction. You can get your questions to us one of three ways. Email is best, and it's thefinalbar@stockcharts.com. We're on Twitter @FinalBarSCTV. We're on YouTube. Put a comment below the video you're watching on our Stock Charts channel. We'll gather all of those questions. We'll hope to answer one of yours live on the air on Tuesday's show of this week. Also, go to StockChartsTV.com. That is our on-demand platform. It's really well designed and so much great content. Every trading day, there are ideas on there, perspective, educational content, but also just a way of making sense of markets in the uncertain times that we're in. Go to StockChartsTV.com. You can use your email address to set up a free account. Also on your mobile device, just search on any of the app stores for StockCharts TV on demand. Let's continue on today's show with our next segment, Shifting Stocks. This completes our three-pronged approach to market analysis, starting big picture, the S&P pulling back, but now in a choppy phase for the last week. We talk about sectors. The interesting sort of dichotomy of a strengthening market today, market moving higher, but some of the defensive stuff, the more value-oriented stuff jumping to the top, things like utilities and consumer staples doing just fine. Now let's look at individual stocks, and we'll hit on a number of different themes. I mentioned last week what I called the ash trade. And I was talking with Grayson Rose here at Stock Charts on Friday, and this is one of the things we could have sort of discussed, and that is basically three areas that I'm seeing strength in the last couple of weeks. A is Apple, S is semiconductors, or home builders. We'll talk about all three of those, I hope, during the shifting stock segment today. But we'll start with Apple. Apple overall doing just fine today, up 2%, outperforming the S&P. Overall, the long-term setup really fantastic. And again, a chart moving higher on improving relative strength in general. I'm going to give the benefit of the doubt to that movement, especially making new highs. And again, the chart will tell you when it's no longer an attractive trend because it will stop making new highs, right? It will make lower highs and lower lows. We're not seeing that on this chart right now. By the way, we can look at the candle pattern and a quick survey. Do you know what this candle pattern is? It's just zooming into the last month. We're looking at today's candle. Do you know what that is? It's actually called a shooting star candle. You saw a similar one back here on the 22nd. This is where you have the open and close near each other toward the bottom of the range of the day. Very little to no lower shadow, right? Lower wick, but you have a long upper shadow. And what that means is you opened near the lows of the day, you traded much higher, but by the close, you got down to the bottom of the day. And whether or not the open is above the close or below the close doesn't really matter as long as they're near each other at the bottom. If you flip that over, it's what's called a hammer candle, which is an open and close near the top of the range, and then you trade lower. That happens after a downtrend. So short term, that's actually a little a negative signal, similar to what you saw here on the 22nd. Saw that candle, you saw a pullback for the next couple of days. So just more anecdotal than anything, but worth noting that you had a nice rally, but then you closed more toward the lows of the day, which is actually a negative candle. Breaking below today's low, by the way, would confirm that and indicate a follow through to the downside. Overall, though, I think the long-term trend remains fairly strong. Semiconductors next, the SMH. The SMH was down a little bit today, but you can see the candle was sort of the opposite. There's a bit of a hammer candle where you opened, you traded lower, and then closed back toward the highs of the day. This is after pulling back for the last couple of weeks, but you can see a similar setup to what you saw with Apple. Sort of this nice long-term uptrend, recently breaking out to new swing highs. I would expect short-term weakness to be fairly constructive because that's an opportunity to get in and potentially ride this move higher. Home builders are the last one. The ITB is what we'll look at here, up 2.7% today, outperforming the market. And this is just this nice classic basing pattern and breaking out on improving relative strength. So I think the ASH trade is a great place to start if you're wondering where to be looking, as I'm thinking between now and year end into next year. Those are three areas that I think setting up pretty well. But let's talk about today in a little more detail. Sort of an interesting day when you look at the healthcare sector. A lot of things either ripping to the upside or ripping to the downside, it feels like. AbbVie was a name that I was looking at last week, and I made a note to revisit it. It's a fairly decent yield for a name up it's a yield of around 4%, which is higher than average for the S&P, which is down just below 2%, if I remember right. But overall, setting up really nicely, sort of breaking out of this resistance. Was nearing that resistance level around 120 today, getting above it, which is a nice breakout of resistance. Overall, setting up really nicely, and I like the upside potential. New 3-month high today, which is encouraging as well. You compare that to charts like Moderna or Pfizer, which are both breaking down today. Now, again, I mean, it's worth remembering this is one day among many days, so let's not draw a broad conclusion. I was taught never draw long-term conclusions from short-term data, right? You want to make sure you're looking at the appropriate trend, but it certainly tells you in the short term that you're having a weakening in Pfizer, breaking down out of below the most recent swing low around 52, down 5% when the market was higher. The RSI is actually really interesting here. If you look, there've been a number of times over the last year or so, a little even more, where the RSI has become overbought. Pretty much every one of those times, you've had at the very least a brief pullback, and that's what we're starting to see today, right? The stock had become overbought through much of the month of November, as it was making a new all-time high here in the mid-50s. From there, rolling over a little bit, coming out of that overbought region. So a short-term pullback at the least is totally reasonable given that sort of environment. The question is the long-term, and so I would say the short-term overbought and coming out tells you short-term weakness. The long-term, though, you want to think more about the highs and the lows. Are we making higher highs, which we have been? Are we making higher lows? The problem on the chart of Pfizer is if you're thinking long-term, we have quite a way to go down before you'd make a new swing low. You'd have to get below around 41, below the 200-day moving average, to break that trend of higher highs and higher lows. So I would be thinking maybe some other ways, trailing stops and others to lock in any sort of gains if you've been in a name like Pfizer. In that same sector, by the way, we'll stick with healthcare. I'm looking at something like Vertex. This is a name I was looking at last week. I was mentioning to the market misbehavior premium members about stock making a higher low. In general, I'm not a huge fan of charts like this because I'd much rather buy high and sell higher, right? Buy strength and sell into further strength. That's sort of the growth mentality, the trend following mentality. But it's always important to look at stocks that are in rotation from distribution to accumulation or accumulation to distribution. I think the chart of Vertex very eloquently demonstrated this rotation from accumulation phase in the first half of 2020 to a distribution phase. Look how we made lower lows, we made lower highs, we broke down through the moving averages, we finally gapped below there and then remained below two downward sloping moving averages for much of the last year. Look at how that's all starting to change. We're back above the 200-day moving average for the first time since last October, over a year ago. We're making a higher low when we bottomed out around 180 a couple weeks ago. From there, we're rotating more to the upside. So I like that sort of rotation. I don't see a problem with looking at that as a potential upside opportunity, as always, assuming you can manage your risk pretty well. Medtronic, one more name in healthcare we'll look at. And I think Medtronic, the chart of Medtronic is what is the challenge right now, right? You have a nice bounce. It is very tempting to get drawn in and think, all right, this is the beginning of the return to previous highs. We're obviously going to get back to the 200-day, keep pounding higher. This is an oversold condition there, third week in November, breaking back out of that. And again, it's a bottom fishing approach. If you want to buy into a name like that, have at it. All I would tell you is, as always, you want to think about your risk. So if you were to buy a name like this, the way to think of it is in terms of risk versus reward. What's your upside potential? That's your potential reward versus managing your downside risk. And for me, I'm looking at 105, which was the low from last week. Holding that maintains a bullish move to this chart, or at the very least, you're locking in those gains above the previous low. We break 105, and all of a sudden, this is just a chart and a downtrend, right? A downtrend has down moves and up moves, right? Up, down legs and up legs. And so overall, a name like this bouncing, it could be interesting. I would just encourage you to think about, defining your risk. For me, something like 105 makes a ton of sense. Boy, we only have a second, but I did want to mention, just with the consumer staples, two names to look at: Procter & Gamble, PG. When I'm looking in a sector like this that's starting to emerge, names making new highs are always interesting. PG is up there with like Costco and Kroger that have had pretty decent trends in a sector that's been fairly troubled. You're even getting a bounce in things like tobacco names, which overall have been fairly negative charts, breaking support, momentum in a negative range, but momentum right at 50. Looking at the RSI, be interested to see if it can regain moving averages. That would draw me in, maybe be a little more tempting than where it's at today. We need to wrap the show. Go to the 3 and 3 charts in 3 minutes. Here we go. We want to highlight one breadth indicator on, on Friday's show. We talked about the Mindful Investor Live chart list. We looked at a series of breadth indicators. When you're looking at the bullish percent index, I would just highlight the fact that we are below 50, and the bullish percent index being below 50 for the S&P tells you over half of the S&P members are in a bearish trend according to their point and figure charts. That's happened 1, 2, 3, 4, 5, 6 times going back to last March. Every one of those times has been an incredibly buyable dip, and we're sort of right there. The problem is the 7th time that happened was February of 2020, before it went a lot lower and we got down to single digits. Almost 100% of the S&P were in bearish point and figure charts, and obviously the price went a lot lower. And this is the problem with market dips and buyable dips. They are all buyable until the last one. The beginning of a distribution always has some sort of bounce where it feels like a buyable dip until we go further. And that's why it's a really important time, if you are jumping into the market here and expecting to have yet another buyable dip. I have no problem with that, as long as you manage your risk effectively. Make sure you think about what would happen if the market would continue lower. Chart number 2, NCLH. We didn't talk a lot about some of these names bouncing today, but things like airlines, hotels, cruise lines, all bouncing really well today. And it's related, of course, to news or implications that the Omicron variant may not be as negative or as troubling as was initially expected when we heard about that a week and a half ago. NCLH is a great chart to pay attention to because it's just bouncing off of the Fibonacci level. The NCLH was oversold, similar to what you saw here when it hit the 38.2% bounced up. You're seeing a similar bounce. Can 1750 hold? That's the thing I would look for there. Finally, lumber prices going higher. The H in the ashtray, the home builders, are certainly motivated by the fact that lumber has gone up. Lumber had such a run higher into May, came down hard into August, but rotating back higher, still very elevated versus pre-coronavirus levels. but moving higher today. Folks, that is our show for today. Thank you so much for joining us every weekday after the close for the final bar. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be safe. Have a good night.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.